The topic for this video is Module 6, Serving Client Needs, Chapter 17, Investment Management for the CFA Institute Investment Foundations Program. So here we are in Module 6, Serving Client Needs. The topic for this video, Chapter 17, Investment Management. It's a really nice follow-up to Chapter 16, Investors and Their Needs. And you can see there are 41 questions in the learning ecosystem. The learning outcome statements for this chapter are Learning Outcome Statement A, describe systematic risk and specific risk. B, describe how diversification affects the risk of a portfolio. C, describe how portfolios are constructed to address client investment objectives and constraints. D, describe strategic and tactical asset allocation. E, compare passive and active investment management. F, explain factors necessary for successful active management. And finally, G, describe how active managers attempt to identify and capture market inefficiencies. So before we jump into the chapter, just a quick review of the investment management process or portfolio management process that we started in the previous chapter. So the steps are: number 1, discover investor risk and return profile and philosophy. Number 2, determine investors' objectives and constraints. And again, that doesn't matter whether it's an individual investor or an institutional investor. It's the same process. Number 3 is perhaps establish a geographic focus. Number 4 is develop an asset allocation mix strategy. That's the strategic asset allocation. Number 5 is develop an investment policy statement. Sometimes you might see these two steps flipped. Doesn't matter. Both are acceptable. Okay. So the previous chapter 16 was looking at investors and their needs, and now chapter 17 we're moving on to the investment management when we're really looking at developing this asset allocation strategic mix. A little bit more on the IPS, and then implementing. And then finally, the last two steps in the investment management process is monitoring the universe and the investor, because investor circumstances can change. If those circumstances change, then you may actually go back and change the strategic mix. In the short term, you may have tactical changes to that strategic mix, but in the long term, the asset allocation mix strategy, that's long term. But anyhow, we've looked at that before, and we'll look at it in more detail. But again, this is an important point. Monitoring the investment universe, changes there might drive some tactical changes, and changes to the investor might in fact change the strategic asset allocation mix. And then finally, the last step in investment management process or portfolio management process is, of course, evaluating and communicating the portfolio performance back to the investor, and that might be a comparison against some type of benchmark. Okay. Learning outcome statement A is describe systematic risk and specific risk. Okay. So the returns on such investments as shares, bonds, and real estate will be affected by general economic conditions. Returns will also be affected by issues that are specific to the particular investment. So first here we're going to look at systematic risk. The risk created by general economic conditions is known as systematic or market-related risk because the risk stems from the wider economic system, sometimes macroeconomic risk you might have heard of. So, for example, if the economy enters a recession, many companies will see a downturn in their revenues and profits. If we move over here to specific risk, though, specific risk, risk that is specific to a certain company or security is known as specific, idiosyncratic, non-systematic, or unsystematic risk. So those are some key terms when we're talking about specific risk. Non-systematic or unsystematic risk. Examples include the share price response when a company launches a successful new product, for example, the Apple iPad, or the response to negative news that a promising new drug has failed in trials. The difference between systematic and specific risk is important because the two types of risk have different implications for investors. An investor can reduce specific risk by holding a number of different securities in the portfolio. Systematic risk will not be eliminated by diversifying an equity portfolio by adding investments such as real estate, because rents and real estate values are affected by the same broad economic conditions as the stock market. An investor can do little to avoid systematic risk because all investments will be affected to some extent. The extent to which two asset classes move together is captured by the statistical measure of correlation. The greater the correlation between asset classes, the more similar the price movements will be. Because systematic risk cannot be avoided, and because risk is undesirable, investors have to be compensated for taking on systematic risk. More exposure to systematic risk tend to be associated with higher expected returns. Portfolio theory suggests that taking on more specific risk does not necessarily lead to higher returns on average because specific risk can be diversified away. Some investors may try to identify shares that they expect to outperform to earn higher returns than expected based on the risk and invest in them rather than diversifying. In the process, investors take on specific risk. If they turn out to be correct, they may earn a higher return as the result of taking on more risk. So again, systematic risk plus specific risk equals total risk. Learning outcome statement B is describe how diversification affects the risk of a portfolio. So we're looking at a graph here. Whenever I look at a graph, I always want to zoom in immediately and understand that what I'm looking at on the y-axis and on the x-axis. And in this chart, on the y-axis, we're looking at risk. Okay, so as we go up, we're increasing the total risk. And on the x-axis, as we go this way, we're looking at the number of shares or different securities. So if we're looking, for example, if we're looking in a stock portfolio, if we have only one stock in the portfolio, we're exposed to not only the systematic risk that many assets are exposed to, but we're also taking on this firm-specific risk. As we said, unsystematic or non-systematic risk, okay, firm-specific. Now, as we add different companies to the portfolio, 5 different companies, 10 different companies, you can see the number that is often in these graphs is at around 30. When you get to 30 different companies, then what you've done is you've diversified away and reduced the firm-specific risk, and you're left with the systematic risk that cannot be eliminated from the portfolio, okay? So diversification is one of the most important principles of investing. When assets and or asset classes with different characteristics are combined in a portfolio, the overall level of risk is typically reduced. So mathematically, a portfolio that combines two assets has an expected return that's the weighted average of the returns on the individual assets. So that's very important to understand. If you're looking at expected return, it's just the weighted average. Provided that the two assets are less than perfectly correlated, the risk of the portfolio, measured by standard deviation of returns, will be less than the weighted average of the risks, okay? Overall, this means the risk-return trade-off, which is a key concern for investors, is better for the portfolio of assets than for the individual assets. And we saw that a little bit in the past looking at that JP Morgan data that the return to risk ratio was quite good if you compared it to against, for example, small cap stocks, okay? So most investors hold more than 2 securities in their portfolios. Adding more securities to a portfolio will reduce risk through diversification, although eventually the additional benefits begin to lessen. The exhibit shows the levels of risk for shares chosen at random from the universe of all shares in the U.S. market. Specific risk, non-systematic risk, is reduced by combining additional shares, but as the portfolio moves beyond 30 shares, the incremental risk reduction becomes small, and the associated trading costs often outweigh any incremental benefit of risk reduction. The exhibit illustrates the concept of specific risk and diversification. Specific risk is highest at the left side of the exhibit, 1 share, and lowest at the right side of the exhibit because much of the specific risk is diversified away. The exhibit also assumes randomly chosen shares, okay? There is potential for greater risk reduction when shares with low correlation with each other are chosen. For example, an investor might combine investments in various stocks and bond markets with investments in real estate and commodities to reduce the overall risk of a portfolio. Okay, this slide is a nice to know, not a need to know, okay? But I know there's a lot of people out there that like math, enjoy math, and if you just understand the math, it's not that too difficult. It really helps you understand this concept of portfolio diversification and why the portfolio standard deviation decreases when you're combining assets with correlations of less than 1, okay? So just basically the point that I want to get at is here is the formula for correlation. The formulation for correlation is covariance of the two assets divided by the standard deviation of x times the standard deviation of y. So x could be a stock, y could be a bond, or they could be two different stocks, whatever. We always start with a two-asset portfolio, so we'll just call the two assets x and y. So the correlation between x and y equals the covariance of x and y divided by the standard deviation of x times the standard deviation of y. And in the quantitative concepts, we did study variance and standard deviation. Recall, standard deviation was the square root of the variance, okay? And we were looking at a sample, not a population. That's why the denominator is n minus 1, okay? And this is a little bit different nomenclatures. This is one of the things, you look at different readings, you see different nomenclatures for algebraic formulas. That's what sometimes intimidates people that don't have a strong math background. But like I said, this is a nice to know, not a need to know. You're not being tested on calculating any formulas. But if you just walk through this a little bit, you're going to see that it's not too difficult to understand. And the other really important thing to understand is that once we have a correlation, we know that that number is a range from -1 to +1, okay? And anytime the correlation between two assets is less than 1, you're going to pick up a benefit of diversification, okay? But I just wanted to show you, so we were familiar from the quantitative concepts chapter on how to calculate the sample variance. We went through the steps. It's the sum of return minus expected return, or the average return squared, divided by n minus 1. And then to get the standard deviation, we took the square root. So you can see in the numerator this x return minus expected return squared. If you expanded that out, you could show the numerator like this: x minus expected return times x minus expected return. This makes the formula look very much like the formula for covariance. I have the formula for covariance right here. How do we calculate covariance? It's simply the sum of x return minus x expected return times y return minus y expected return, or average return. This is one of the things with finance. Expected return, we also, sometimes you hear expected return, or you heard the term average return. This x bar is the average return, y bar is the average return, okay? So you can see there's our sample variance, which we did cover, and there's our covariance, very similar. So I just wanted, because if I show you the formula for correlation, covariance divided by standard deviation x times standard deviation times y, you'd say, oh, we haven't really learned how to calculate the covariance, but it's really easy. It's just expanding on how we calculated sample variance, but now instead of one asset, we've got two. So we want to see if, we want to be able to calculate mathematically if they're moving in the same direction or not. So we calculate the covariance. So the steps, we're going to calculate, x minus x bar, return minus average return x, times return of y minus average return of y, divided by n minus 1. That gives us our covariance. Then our correlation is covariance of xy divided by standard deviation of x times standard deviation of y, okay? And with a little bit of the algebra, just moving this over, to isolate the covariance of x and y equals the standard deviation of x times the standard deviation of y times the correlation. Again, I wanted to show you this is just the same thing. Sometimes you see different nomenclatures. Here it's COR, XY, or sometimes they use a big R. Okay, so 4 minutes on a nice to know, not a need to know, but this, I just want to pop in a couple of minutes on showing how we actually calculate the correlation. It's not that difficult. Again, this is just continuing with the nice to know. You don't need to know this. So don't be stressed out. If math is not your strength point, you could skip this part of the video. But if you're curious about it, I think you'll hopefully get a better understanding by bearing with me for a minute. So number one, and we always start with a two-asset portfolio as the foundation, just to, if you add more assets, you're just expanding the math. So we always just start with a two-asset portfolio in the readings. And so number one, the expected return of a two-asset portfolio is just the weighted average, okay? So that's the weight 1 times return 1 plus the weight 2 times return 2, okay? We mentioned that. But when we get into the standard deviation of a portfolio, which is the square root of the portfolio variance, it's not the weighted average. Here's the formula. It's weight 1 squared times standard deviation 1 squared plus weight 2 squared times standard deviation squared plus 2 weight 1 weight 2 times the covariance between x and y, okay? So we can see, this is why I wanted to start with the previous slide, we can see that the formula for the standard deviation of a portfolio includes covariance. Yes, because assets may not necessarily be moving in the exact same direction. They may not have a correlation of 1. So we can rearrange the formula for covariance, and that is what I was doing on the previous slide. Covariance also equals standard deviation of x times standard deviation of y times the correlation of x and y, and we know that that number can go from -1 to +1. So of course, if it's negative, it's going to be reducing the standard deviation of the portfolio, but even if it's less than 1, the portfolio standard deviation is going to be reduced, okay? So I've rewritten the formula for portfolio standard deviation to show it's the square root of the variance, which is weight 1 squared times variance 1 plus weight 2 squared times variance 2 plus 2 times weight 1, weight 2 times standard deviation 1 times standard deviation 2 times the correlation. Okay, so any correlation less than 1, then the portfolio standard deviation will decrease. And that's why I was saying it's just a function of math. Expected return of a two-asset portfolio is the weighted average, but we can't use that for the standard deviation of a portfolio weighted average because of covariance, assets not moving in the same direction. Here's the formula, and it includes covariance, or we can rewrite it. Covariance equals standard deviation x times standard deviation y times the correlation, a number between -1 to +1, and therefore any correlation less than 1, standard deviation will decrease. Okay, this again is just a little nice to know, not a need to know. It's a spreadsheet that I developed that I like to use in my classrooms teaching CFA because this is a very important concept, and it's just if you just work through it with a little bit of math, you'll find that it's really easy to understand. So here I'm looking at a two-asset portfolio. I'm calling this a stock. The expected return of the stock is 10%, and the expected standard deviation of the stock is 20%. I'm using numbers kind of similar to what we saw for the Ibbotson. Then I have the expected return of, say, a bond, 5%, and the expected standard deviation of the bond being 8%. So we can see this is a two-asset portfolio. So we start from 0% weighting in the stock, so that would be 100% in the bond, and we move through increments of 10% till we have 100% weighting in the stock, 0% in the bond. So you can see 100% in the stock, our expected return would be 10%, and our expected standard deviation would be 20%. If we had 100% in the bond, we'd have the expected return of 5% and the standard deviation of the 8%. So let's just start at the 50-50 portfolio because that's easy to understand, and you can see that the expected return is simply the weighted average. And you can do that math in your head. That would be a half of 10% is 5, plus half of 5% is 2.5. Expected return is 7.5%, okay? Now, if we look at, here's where I can adjust my correlation. Here I'm starting with a correlation of 1, so therefore if a correlation is 1, then the standard deviation of the portfolio is just going to be the weighted average. So you can see here half of 20 is 10, half of 8 is 4, so the standard deviation would be 14%, okay? Now look at, if I adjust this, and here's my, the formula, it's the square root. I've just written out the formula for the square root of the, for the standard deviation of a portfolio, which is the square root of the variance. Now here, if I reduce that correlation between, and you can see, number one, when you have a correlation of 1, this is the graph of my portfolio. On the y-axis, the expected returns, and on the x-axis, the risk. So again, down here, you can see that's 100% in the bond portfolio, because the expected return is 5% and the expected risk is 8%. Okay, and up here, that would be 100% in the stock portfolio, because the expected return is 10% and the standard deviation is 20%. And these are the plottings, for the different weightings. Okay, so the 50-50 you could find, that would be 7.5% in terms of expected return, and 14% in terms of the standard deviation. Now you can see here, so just remember these expected returns from 5% up to 10%. If I decrease the correlation to, say, 0.5, what's going to happen? The curve starts to, it's not a straight line anymore, it starts to curve. Now you can see nothing has changed to the expected returns, but my standard deviation of the portfolio has gone down. The at the correlation of 1, it was 14%. When I reduce the correlation to 0.5, it's 12.49%. So again, if I make this a 0 correlation, you can see it reduces further. And in fact, we saw that there was negative correlation between stocks and bonds from that JP Morgan correlation matrix of, say, 0.35. And you can see the portfolio diversification has, no change to the expected return, but the portfolio standard deviation is really decreased to 9.38%. Okay, so if I made this a negative one, you're going to see what happens. It goes right back to the right back to the y-axis. Okay, so again, that was another 4 minutes on portfolio standard deviation, the benefits of combining assets with correlation of less than 1. It's really a key point. Really have to understand it. It's just a function of the math. And if you forget about the algebra, I just built in a little spreadsheet. Most students say, aha, I get it. Expected returns doesn't change. That's a weighted average. But based on the fact that the formula for standard deviation of a portfolio includes correlation, which could be a number from -1 to +1, as I reduce that correlation from 1 to lower numbers, I get the benefits of the diversification. Even if I type in 0.8, fairly high correlation, the standard deviation on the 50-50 portfolio is less than 14%. It's gone down to 13.42. Okay, so hopefully that has helped your understanding. I've put it in here. It's a nice to know, not a need to know, but it's such a key and crucial, important part of portfolio management, investment management. So now we can move on. Learning outcome statement C is describe how portfolios are constructed to address client objectives and constraints. Okay, so after developing the investment policy statement, which includes, among other information, an investor's willingness and ability to take risk, the asset allocation of the portfolio is determined. This determination involves decisions regarding which asset classes are suitable. For example, global equities, domestic government bonds, commodities, domestic real estate investment trusts, REITs, real estate investment trusts, and the proportion of the portfolio to invest in each asset class. In some cases, the asset allocation decision is documented as part of the IPS. In other cases, asset allocation is regarded as part of the subsequent implementation of the IPS, and that's just why I said, depending on, you might see different text or different reading that is, flipping those steps. Step number 4 could be develop the investment policy statement, and 5 could be developing the asset allocation mixed strategy. It doesn't really matter. Okay, it's just you might see it in 2 different ways. Anyhow. Strategic asset allocation is the long-term mix of assets that is expected to meet an investor's objectives. Again, strategic asset allocation, long-term mix. Strategic asset allocation is a decision that has a great impact on the long-term returns on a portfolio. Although the strategic asset allocation should meet the investor's objectives over the long term, the manager investor can potentially increase returns by exploiting short-term fluctuations in asset class returns. And that's why I wanted you to understand the JP Morgan checkerboard of asset class returns from 2003 to 2017. You can see there's a lot of variance and fluctuation. The process of exploiting these short-term fluctuations by adjusting the asset class mix in the portfolio is known as tactical asset allocation. So the investment, this up here, the investment policy statement. What are the investor's objectives? What are the investor's constraints? And that is an input into the asset allocation decision. Which asset classes do we invest in? What portion of the portfolio is invested in each class? Okay, so that's why we move from investors and their needs in the last chapter, understanding their risk and return, their objectives and constraints. Now we're moving into the investment management, setting up the portfolio. So now we're continuing with the strategic asset allocation process. Okay, so it's a process, and it's quite important to understand what that process is. So strategic asset allocation typically requires the manager to estimate the expected return and risk of each asset class. And that's why in the past we looked at historical returns from the Ibbotson SBBI yearbook on the different asset classes, stocks, bonds, and cash-like securities, treasury bills, and then we looked at inflation, again here from 1926 to 2012, what the asset class returns and what the risk were. And for the stocks, it was split between small cap and large stock, the bonds between long-term corporate bonds and treasury bonds. Okay, we saw the growth of $1 from 1926 up here in this graph until 2017. And this is why we're building on that now, because historical returns can be used as a guide, but estimates need to be forward-looking. Okay, the manager also needs to determine the correlation of returns because the asset class of the asset classes, so that he or she can calculate the diversification benefits that may be achieved by combining the various assets in the portfolio. And that's why we looked at the JP Morgan Guide to the Markets, September 30th, 2018, which had the 10-year correlations and volatility of a number of different asset classes. Okay, so you can see how, again, it's coming together. But the first step in the strategic asset allocation process, it's very important to understand, is estimates, expected returns of the asset class, estimates, expected volatility, standard deviation, and estimates of the correlations between the asset classes. Okay, so then the chosen strategic asset allocation is expected to meet the investor's long-term risk and return objectives. An investor may set the strategic asset allocation and simply hold that portfolio for the life of the investment. If the investor does so, the proportions of the portfolio will likely depart from the chosen weights because the different asset classes provide different rates of return and their values increase or decrease by different amounts. As a result, the portfolio has to be adjusted through a process called rebalancing, which involves selling some of the holdings that have increased as a proportion of the portfolio and investing the proceeds into the holdings that have decreased as a proportion of the portfolio. Okay, so you set the initial long-term strategic asset allocation mix, but that will change, and sometimes there is some rebalancing. There's a fair bit of academic literature talking about the benefits of rebalancing. It says an investor may set the strategic and simply hold that portfolio for the life of the investment. We'll talk about that a little bit more later in the video. So a quick practice question from the learning ecosystem to check our understanding. This one's classified at the moderate level. All things being equal, investors prefer higher investment returns with A, greater risk, B, higher volatility, or C, predictable outcomes. So the correct answer is C. All other things being equal, investors prefer higher investment returns with predictable outcomes. All things being equal, investors want to obtain higher returns with lower levels of risk, i.e. investments with highly predictable and favorable outcomes. So it says A is incorrect because investments with uncertain outcomes, again, that was the definition of risk. It's not only volatility, it's the uncertainty that comes with the volatility. You might have to sell an asset at a lower price than you may want to. If you had to do that, that's considered high risk. Okay, and B is incorrect because investors want to obtain high returns with lower levels of risk, i.e. investments with highly predictable, favorable outcomes. Moving on to Learning Outcome Statement D. Learning Outcome Statement D describes strategic and tactical asset allocation. So I just want to stay on the strategic asset allocation just for a little bit. And so just to talk a little bit quickly about this core satellite investing. Now, as I mentioned, a core portfolio can be very simple, just made up of the asset classes of stocks, bonds, and cash, okay? So the long-term strategic asset allocation profile for some investor might be income. It might be an older person, family that's retired, and they're relying on income. And they want less volatility, shorter time horizon. So they might have more assets allocated to fixed income than they do for stocks, okay? If we move to a growth portfolio, you can see that we're going to reduce the percentage of the portfolio allocated to fixed income and cash, and we're going to increase the proportion dedicated to equities. Now, as I said, there's this concept that is called core satellite investing. The core portfolio, stocks, bonds, and cash, we call that traditional asset classes. But as we saw on the chapter on alternative investments, depending on the individual or institutional investor, they might start investing in private equity, real estate, commodities, hedge funds, investments of passion, and we don't talk much about structured products and derivatives. But anyhow, those might be seen as kind of the satellite to the portfolio. And indeed, if we looked at, for example, the Abu Dhabi Investment Authority portfolio in the previous, we can see that, really at the core of it, a big percentage is dedicated really to the traditional asset classes, stocks and bonds, okay? Now, I just wanted to be a little bit more specific. We've shown these 6 portfolios before: secure, income, conservative, balanced, growth, and aggressive growth. I got this from RBC basically back in 2008, but I just want to add a little bit more detail to it so you can see cash, fixed income, and equities. And so here I have the secure, I have the income, I have the conservative, balanced, growth, and aggressive growth. So we could have a range, and then we have a target mix, okay? So you can have a target mix, but there's a range, and that gives you some ability to move within the ranges for some tactical decisions. If you thought that in the next short term that equities were going to outperform fixed income investments, you would increase your investments within that range, okay? So this is typically something that you might see with regards to a portfolio, or even included an investment policy statement, that if determined that the portfolio is going to be growth oriented, that the range for cash is 0 to 20%, we're going to keep 5% on hand. The range for fixed income, 5 to 35%, but our target mix is 20. And for equities, the range is 55 to 95%, so you can see very aggressive at the upper end of the range, but the target mix of 75%. And the target mix is always going to sum to 100%, okay? So the desired overall risk and return portfolio, the portfolio is a factor in determining the strategic asset allocation. A portfolio with a strategic asset allocation dominated by global equities would be expected to have a higher return and be more volatile than a portfolio dominated by domestic bonds, because bonds generally have a lower risk than equities and thus produce lower returns. And that's why we've looked at all that historical data. The strategic asset allocation suitable for one investor may not be suitable for another. Academic studies have demonstrated that the strategic asset allocation significantly affects the average returns on the portfolio. So it's not the individual investments within the stocks or the individual bonds, it's the asset class, okay? It's the strategic asset allocation is driving the average return on the portfolio. Thus, asset allocation warrants considerable attention from investors, investment managers, and investment advisors. So this is my own slide. It's a nice to know, not a need to know. And again, this is just cut out from the Abu Dhabi Investment Authority annual review. And this, as we showed you before, this is a very large institutional investor. It's a sovereign wealth fund, okay, one of the largest in the world. And we could see that they were looking at they don't give their assets under management in the annual review. That's estimated by organizations, sovereign wealth funds, institute, etc. But nevertheless, they do give their portfolio by asset class, and this is the long-term policy portfolio. So you can see developed equities, emerging market equities, and small cap equities. Those are stocks. So at the low end of the range, 32 plus 10 plus 1, that's 43% as a minimum allocated to stocks. At a maximum, the range 42 plus 20, 62, plus 5, 67%. So we're looking at 43% to 67% just on stocks, and that's my point, is that that's not much different than an individual. The difference for an individual would be you're not going to be perhaps able to dabble in private equity or infrastructure, okay? And depending on the size of the portfolio for an individual, you may or may not be considering alternatives, which you could see alternatives comprise hedge funds and managed futures. Retail investors typically are not going to be involved investing in alternatives, but high net worth investors, ultra high net worth investors, that might be included. But you can see here, government bonds and credit. These are government bonds. Credit is corporate bonds. Are also making up a minimum of 15% to a maximum of 30%. So you can see here, a portfolio. Let's round that up: 70% in stocks and 30% in bonds, or maybe reduce each by a couple of percentage and having a little bit in cash. My point is, it doesn't matter whether it's an institutional investor with multi-billions or an individual. Actually, the portfolio by asset class can be kind of similar. And the other key point that I always like to point out is that 50% of Abu Dhabi Investment Authority's assets are invested in index replicating strategies, and these are the ETFs, okay? So yes, they've got 1,100 people working for them, or 1,200 people working for them, and 55% are managed by external fund managers. But for an individual, if you set up a 70% stock, 30% bond portfolio and used ETFs, well, your returns and your risk profile might not be all that much different than a big institutional investor, okay? So here, just again, taking my growth portfolio, and this is just for illustrative purposes. I'm not recommending this, but you can see the asset allocation between the cash, fixed income, and equities. I'm looking at the growth portfolio. Well, we may want to break that down to specific ETFs. I looked at the iShares website for the U.S., and this is the most assets in terms of a bond fund are in the iShares Core U.S. Aggregate Bond Fund ETF. You wouldn't do too badly by putting your 20% of your target mix in one ETF covering bonds. But then in terms of the equities, 75%, you might want to break that up, because you can see here developed markets, emerging markets, the small cap is quite small. When we talk about the developed markets, we could split that between the core S&P 500 and the MSCI Europe, Asia, and Far East. The S&P 500 has done much better, so I have 50% there, 10% in Europe, Asia, Far East, just as a matter of diversification, and 15%. You can see here emerging market equities, 10 to 20. I picked the middle at 15% for just my illustration, and I've put 15% in the emerging markets. So for the stocks on the developed, I broke that up to S&P 500 and the Europe, Asia, Far East, and then for the emerging markets, that's the iShares Core MSCI Emerging Markets ETF. So you can see here, I've built the portfolio just using 4 ETFs. Okay, it's going to be low cost, it's going to be easy to manage, and quite frankly, long term on average, your results are going to be probably not all that bad. And it's quite simple. Stick to simplicity. That's the message that we saw from Jack Bogle in earlier videos, and it's something that I believe in. Okay, again, this is my own slide. It's not in the CFA Institute Investment Foundation's program curriculum, but I found it here from a company called Index Fund Advisors. I just like the graphics, so I used it. Need to reference it. Found it back in 2014, and it's showing the emotions of rebalancers. So it's showing a hypothetical 5-year period. So here's like the portfolio. It has its ups and downs, is what we've seen, and then the rebalancers emotions over time. If you have a business-like approach to investing, and you have a business-like approach to portfolio rebalancing, you can see that as the the stocks, the asset has increased in value, the proportion of the portfolio dedicated to stocks is increased. So what you would do is you would sell a portion of it, and you would invest that into the bonds, and then if it decreased, you would take that opportunity to buy a portion to restore the target allocation. Okay, so that's in terms of rebalancing. That again, that's a process, and there's different philosophies. The next slide, I'm just going to show you a couple of quotes to show you that the verdict is still out, the jury's still out on the different approaches to rebalancing. So here's just a couple of quotes regarding rebalancing. Again, this is not in the curriculum, but it's just nice to know, okay? So in his book, The Investor's Manifesto, Preparing for Prosperity, Armageddon, and Everything in Between, William Bernstein recommends rebalancing a non-taxable account every 2 to 3 years, okay? For taxable accounts, he recommends rebalancing less frequently. Why? Because every time you sell a stock for a capital gain, you'll pay tax. You'll also pay a commission every time you buy and sell a stock or exchange-traded fund. Rebalance your portfolio approximately once every few years. More than once per year is probably too often. In taxable portfolios, do so even less frequently. So that's what, some comments on rebalancing from William Bernstein. Down here at the bottom, I've got some comments from John Jack Bogle, and he compared the performance of rebalanced against non-rebalanced portfolios, each starting with a 50-50 split of stocks and bonds over consecutive 25-year periods going back to 1826. The portfolios that were rebalanced annually won 52% of the time, but he considered that to be a result so insignificant he considers it noise. In a second study, Bogle examined a diversified index portfolio of United States large caps, 48%, small caps 16%, international stocks 16%, bonds 20% for the 20 years ending in 2006. When the portfolio was rebalanced annually, it returned 9.71%, compared with 9.49% with no rebalancing, a difference he also dismissed as noise. Okay, so there's some again on rebalancing, it's not set in stone what the exact advice is, and my advice is less rebalancing, and I'll tell you why. If you're owning stocks and you're involved in a dividend reinvestment plan where the dividends are used to purchase even fractional shares of a stock, which is sometimes you've got that opportunity. When the stock prices come down and the dividends are being paid, you're going to be accumulating more shares or fractional shares in the security when the prices are down, and when they recover as they ultimately do, you're going to be in a far better position than having been trying to rebalance. Okay, so my personal philosophy is to rebalance very infrequently. But anyhow, again, that's open for discussion and debate, and is perhaps a bit of a philosophy that's still open for debate. So just a quick graphic again from Index Fund Advisors, and so this would be not rebalancing, and so it'd be a passive investor, not rebalancing, and it's just saying that again, taking a relaxed and business-like approach to investing, you're going to be, you need to save to invest. So as you're saving money through time, you're just continually investing. The market's high or the market's lower. You just have a disciplined program of buying. Now, again, if your stocks are way up, you might be buying a little bit more bonds to continue your getting back to closer to your strategic asset allocation. But what it's saying is that you're not doing any active rebalancing here. You're just saving, and when you've got savings, then you're going to be buying, and so it's a passive investor's emotions over time. You're going to be relaxed. You're following a disciplined process, not trying to time the market. You're not trying security selection. You're not trying any activity, and you're not even frequently or actively rebalancing. So we're going to be moving on to tactical asset allocation, but before we do that, I just want to inject a quote, a couple of quotes here from Warren Buffett. So Warren Buffett said that most investors, of course, have not made the study of business prospects a priority in their lives. If wise, they will conclude that they do not know enough about specific businesses to predict their future earning power. I have good news for these non-professionals. The typical investor doesn't need this skill. In aggregate, American business has done wonderfully over time and will continue to do so, though most assuredly in unpredictable fits and starts. We've seen that, trends in the market, the volatility. In the 20th century, the Dow Jones Industrial Average has advanced from 66 to 11,497, paying a rising stream of dividends to boot. The 21st century will witness further gains, almost certain to be substantial. So I put this here in bold. The goal of the non-professional should not be to pick winners. Neither she nor her helpers can do that, but should rather be to own a cross-section of businesses that in aggregate are bound to do well. A low-cost S&P 500 index fund will achieve this goal. So now we're going to look in more detail at tactical asset allocation, okay? So although the chosen strategic asset allocation is expected to meet the investor's objectives over the long term, there are times when shorter-term fluctuations in asset classes may be exploited to potentially increase returns. This short-term adjustment among asset classes is known as tactical asset allocation. So remember, we start with the strategic asset allocation. That's the portfolio. It could be balance, could be growth, aggressive growth, income. But as we saw, this is now you understand why we're looking at the asset class returns from JP Morgan Guide to the Markets from 2003 to 2017 is showing the different asset class returns. And if we looked at small cap equities, you can see there's a lot of volatility there. So at the end of the day, a high risk but high return. So we could look at the return to risk ratio, you know. And then if I'm going to change colors here, just a second. If we look at the portfolio here, you know, there's less volatility because you're combining the different asset classes. Okay, so that portfolio might be your strategic asset allocation. Okay, we can look at the percentages in the fine print. And that has a pretty good return to risk ratio. That's kind of showing us the benefits of diversification. Less return, you know, here's a single asset class return quite high, but high volatility. Combine them into a portfolio, not bad volatility, pretty good return, pretty good risk, okay? The short-term adjustments among asset classes is known as tactical asset allocation. So for example, assume an investor has a strategic asset allocation of 60% global equities and 40% European government bonds. The manager may think that the global equity market is overvalued and is likely to face poor returns in the short term. In response, the manager could adjust the asset allocation to 50% equities and 50% bonds. If the manager's expectation is correct, this 50-50 portfolio will perform better than the strategic asset allocation of 60-40. The manager will have added return for the investor versus maintaining the strategic weights on a static basis. But forecasting markets is difficult, and tactical deviations do not always benefit the investor. The difficulty of forecasting means investors may choose to maintain their strategic allocation within predetermined ranges. And that's what we looked at. The range, unless it gets outside of that range, you don't do anything. So for example, this acceptable strategic asset allocation may be determined to be 56% to 64% global equities and 36% to 44% European government bonds, rather than the 60% global equities and 40% European government bonds. Such ranges allow for some tactical asset allocation and reduce the frequency of portfolio rebalancing. And I just wanted to finish this slide to show that this tactical asset allocation may not only be asset classes, it can be region, country, asset class, sector, company, you know, these tactical moves. And just again from Credit Suisse 2013, we looked at this before. The strategic asset allocation is your long-term investment strategy, assumes that markets are efficient, define the benchmark, and you need the long-term risk and return assumptions. But the tactical asset allocation is the short to medium term. Assumption is markets are inefficient, some assets are not at fair value. You correctly forecast the correct value, and you're right, you're going to make money. That's active management, though, because you're actively trying to you know, exploit these variances in different asset class returns. And so what do you need? You need very complicated models to identify misvaluation of assets. Okay, that's activity, expertise, and that's cost. A quick practice question to check our understanding of the learning ecosystem at the expert level. The question is, when making tactical asset allocation decisions, an asset manager would rely on which of the following tools? A, trend analysis, B, expected returns for asset classes, or C, correlation of returns between asset classes. So I like this question. It's a good review. So when making tactical asset allocation decision, an asset manager would rely on trend analysis because they're being active. So they're looking at different data to make decisions, okay? Remember B and C here. This is why I say this is a nice review. Look what B and C are being given as. Expected returns for asset classes, that's from the strategic asset allocation. Remember, we start by estimating these expected returns and the risk measures. And the correlation of returns between asset classes, it says, yeah, we're also estimating that in the strategic. So that's what A is correct. An investor or manager typically uses a variety of tools and inputs to make tactical decisions, and trend analysis is one such tool. You have to know what some of the other tools are, okay? And expected returns for asset classes, strategic asset allocation. Correlation of returns between asset classes, again, used in the strategic asset allocation. So this is a good and important slide. We're continuing with tactical asset allocation. We're looking at factors affecting tactical asset allocation. So as we have said, the investor or manager typically uses a variety of tools and inputs to make tactical allocation decisions, and the decisions may be based on fundamental analysis of economic and political conditions and their likely effects on market returns, on market valuation measures relative to past experience, and or on trends and momentum in markets. In practice, such decisions are often based on a combination of those factors. Anyhow, fundamental analysis is company analysis. You're having to you have to come up with estimates of the company's earnings, and therefore you're looking at top down all the economic and political conditions. So fundamental analysis is the big macro, but it's also the study of companies and their financial statements. Okay, so the manager may look at the strength of the economy and future trends to gain perspective on how the central bank might change interest rates and on what might happen to corporate profits. The manager could then look at the level of the price-to-earnings ratio in the stock market and how it compares with recent decades as a measure of valuation, or with the level of bond yields relative to historical ranges. The manager could also look at stock and bond market trends as a way of gauging investor sentiment. So some of the factors affecting tactical asset allocation: economic conditions, political conditions, central bank policies, current valuations versus historical. That's where we see reversion to the mean. And recent market trends, we've had a big boom, maybe we're expecting a correction, etc. All these different factors affect tactical asset allocation. And the important thing to say is that decisions have to be made, overweighting and underweighting, and those tactical decisions can go right, but they can also go wrong. They're going to be deviations from the benchmark. A quick practice question that I like from the learning ecosystem expert level. The question is, which of the following would be a valid reason for an asset manager to deviate from an investor's strategic asset allocation? A, a change in economic conditions. B, a large change in the investor's risk profile. Or C, to exploit short-term investment opportunities? Good question. The correct answer is B. A large change in the investor's risk profile would be a valid reason for an asset manager to deviate from an investor's strategic asset allocation. Remember, strategic asset allocation is the long-term asset allocation. So what would be a valid reason for deviating from it? It would have to be a change in the investor's risk profile, okay? If we look at A and C, a change in economic conditions or exploiting short-term investment opportunities, those are all tactical asset allocation decisions, okay? So a nice little question. You have to zoom in and really understand the difference between the strategic asset allocation, the tactical asset allocation, and it's the investor's risk profile that determines the initial strategic asset allocation. And the only way you would deviate, a valid reason for deviating for that would be a change in the investor's risk profile. Let's say they won the lottery, or they're moving from high income now to retirement, okay? But change in economic conditions, that's a factor in the tactical. And exploiting short-term investment opportunities, that's tactical. Learning outcome statement E is compare passive and active investment management. So here we have a graph. On the y-axis, we have performance. That would be percentage returns. On the x-axis, we have time. So the graph here, it looks like an index. And yes, we could say that perhaps that is the S&P 500 index. Okay, so you can see there's two other colored lines. One is the green line, and that's passive management. That would be, say, using an exchange-traded fund like we looked at, and that's meant to replicate the performance of the S&P 500. But however, there might be a little bit of tracking error. And the other colored line is the active management, where you're making short-term tactical active management decisions, and your objective is trying to outperform the benchmark to create some alpha, okay? So before deciding a portfolio's asset allocation, investor must also decide whether to use a passive or active management approach. Passive investment managers seek to match the return and risk of a benchmark. Benchmarks include broad market indices, indices for a specific market segment, and specifically constructed benchmarks. Passive investment managers attempt to minimize tracking error. Tracking error is the deviation of the return on the portfolio from the return on the benchmark being tracked. Passive managers may try to fully replicate the benchmark by holding all the securities in the benchmark in proportions equivalent to their weighting in the benchmark. But you can see that's not very realistic in all cases to be able to buy all the securities in the proportions. So because benchmarks are difficult and costly to fully replicate, passive managers may use a tracking approach, holding a subset, basically holding a very high correlation to the total market with less holdings, and that's expected to closely track, but it's not going to be exact. So that's where you get the tracking error from, okay? Active investment managers use a variety of approaches. They may attempt to select assets that will outperform the benchmark. These active managers focus on selecting individual securities or assets in an asset class or classes. I showed that graph before. This would be different geographies even. So active managers may also try to time a market, buying when they believe the market is undervalued and selling when they believe the market is overvalued. So there's, when you're active with your market timing, or you're active with your security selection, you're active with both, okay? So the choice between the two approaches typically hinges on the relative costs of active management and on the investor's expectations of his or her chance of success at active management, which is related to the investor's belief about the efficiency of the markets being invested in. Another example of active management is the timing decision among asset classes, as illustrated by the tactical allocation. Learning outcome statement F is explain factors necessary for successful active management. Factors needed. Active management is a challenging task, but there are managers who have impressive long-term records of success. For active managers to be consistently successful, they have to be better than the other investors at assessing the potential of investments. For active managers to identify outperforming securities on a consistent basis, they must either have access to better information than other investors, or be able to respond and use the same information faster or with better models to process the information. In many markets, corporate disclosure regulations mean that information on company fundamentals must be made available to all investors at the same time. In fact, laws typically prohibit selective disclosure of material information on company prospects or performance. Also, for active management to be successful, any mispricing of investments has to be substantial enough to cover the costs of exploiting this mispricing. So it takes a lot of analysis. That takes horsepower, that takes people, that takes money, okay? So you can also see that active management is going to be more difficult in very efficient markets. In less efficient markets, frontier markets, where there's more spotty financial reporting, inside information, less investment research coverage, active management can work. It works less well as markets become more efficient, okay? So choosing between passive and active management, the choice between passive and active management is a key issue for investors, and the decision must be weighed carefully. Passive management is typically cheaper to implement. That's the big thing. Low-cost ETFs, not a lot of activity. Passive management is cheaper to implement than active management because successfully replicating or tracking a benchmark requires fewer analytical resources than researching and identifying investments with superior return potential. But for some markets, such as real estate, in which all properties are unique and trading is done in private transactions rather than on a public stock exchange, it is clear how a passive approach can be used. Active approaches, it's less clear how a passive approach could be used. Active approaches require a more detailed analysis of each relevant investment or asset class, which is costly because investment firms need skilled employees and/or expensive technology. Concerns about the costs, the average or below average performance of most active managers, and the difficulties of identifying active investment managers who outperform in the future have made passive investment strategies increasingly more popular over time. Yeah, so the story is long-term on average, a lot of active managers don't outperform their benchmark. Fees and expenses are negative performance. And, in general, on average, just the S&P 500 index has done very well. So investors say, if that's how well the index does, I'm happy with that performance. And because, I have a chance if the active manager is not going to outperform. And it's expensive. So a quick practice question at the difficult level from the learning ecosystem, and the question is, compared with passive management of a particular asset class, active management most likely A, has lower transaction costs, B, results in a risky portfolio, or C, requires more analytical resources. The correct answer is C. Compared with passive management, active management most likely requires more analytical resources. Yes, correct. More people, more technology, more tools, more analytical resources. Active management of an asset class involves analyzing and selecting undervalued securities, requires more skilled employees, data, and computing power than passive management. So A and B are wrong. Active management typically involves more trading than passive investing, as newly discovered underpriced securities are purchased, newly discovered overpriced are sold from the portfolio. So active management is going to have higher transaction costs, okay? And resulting in a risky portfolio, not necessarily, okay? An active managed portfolio might be more risky, might be less risky, or at the same risk level, okay? On average, actively managed portfolio would have the same level of risk as the asset class as a whole. Learning outcome statement G is describe how active managers attempt to identify and capture market inefficiencies, okay? So there's 3 techniques here. Number 1 is fundamental analysis. Number 2 is technical and behavioral analysis. And number 3 is quantitative analysis. Here on the right-hand side, I have a graphic from an RBC document from 2008, and it's called Managing the Process. So you can see up here, they've got the investment strategy. There's the top-down analysis would be the macro. That's the global, the country, the industry. But down here, when we get to the individual stock screening analysis, we call that the bottom-up, and so you can see there's 3 research disciplines. 1, fundamental analysis. 2, technical analysis. And 3, quantitative analysis. So it's exactly the same as the content in the Investment Foundations program. So this is a nice real-world example, okay? So this is going to take a little bit of time. We're going to go through the differences and similarities between fundamental analysis, technical and behavioral analysis, and quantitative analysis. So Active managers often try to identify and capture market inefficiencies through fundamental analysis. For equity investors, this process means conducting a detailed and thorough analysis of a company's business model, its prospects, and its financial situation. This analysis may involve meeting with company management and interviewing them about their strategy and the prospects of the company. The analyst must take care not to violate laws and regulations when gathering information. Their goal is to identify companies that have better prospects than the stock market price reflects. Typically, an analyst or manager performs some form of fundamental analysis to arrive at an estimated value for a company share. That's what the CFA Research Challenge is all about. The students have to do an analyst report, and you give a price target 1 year from now through using a very price to earnings, different models or discounted cash flow dividends, things that we've studied a little bit in this course, and you come up with the expected price 1 year from now. Then you look at the return, ending price minus beginning price plus any expected dividends divided by the beginning price, and you make the recommendation buy, sell, or hold. Okay, so that's what the fundamental analysis is all about. A value that is estimated this way is called the stock's fundamental or intrinsic value. Although fundamental values are not observable, many active investment managers work hard to accurately estimate them. When analyzing fixed income securities such as bonds, notes, and bills, managers consider borrowers' ability and willingness to pay their debts, that is, borrowers' creditworthiness and trustworthiness. When analyzing equities, they pay close attention to the issuer's future prospects for earning money and producing valuable assets. Okay, moving on now to technical and behavioral analysis. Managers using technical analysis study market information, including past price patterns and trading volumes in the stock market, to identify shares that may outperform or underperform. So an active manager who believes in momentum will try to invest in shares that have recently been rising in the market, which is based on the notion that a rising share will continue to rise. Some investment writers have said that momentum trading is you should be buying low and selling high, but this technical signal is telling you to buy when the price is really rising. Okay, so anyhow, managers using behavioral analysis focus on indicators of market sentiment, such as manufacturers' new orders or indices of consumer expectations. So that's behavioral stuff, looking at statistical economic data. Investment managers who use technical and behavioral approaches try to buy a particular security or asset before an increase in buyer interest or a decrease in seller interest causes the prices of the security to change. So they try to sell before an increase in seller interest or a decrease in buyer interest causes the price of the security to fall. Moving on to quantitative analysis, some managers build statistical models. So quant data is looking at statistical models that try to identify shares that are likely to outperform. By analyzing data, they identify characteristics that have typically been associated with share price outperformance. So for example, the analysis might suggest that companies with below market average valuation levels, for example, the ratio of the share price to earnings per share, known as PE, and above average expected earnings growth, tend to outperform. This insight can then be used to search for shares currently showing these characteristics. So managers using this approach are often called quants because of the quantitative models that they use. So as noted earlier, managers may use a combination of these three types. So we saw that at RBC. They're using all three, those three research disciplines. You've got professionals in all three disciplines. That costs a lot of money. Anyhow, depending on the asset class, or market being analyzed, the approach is used, and the precise variables of interest will differ. Anyhow, one last quick practice question to check our understanding at the expert level. An active investment manager who studies large institutional investors and attempts to predict when they will sell large positions in securities so as to trade in advance of the large volume is most likely engaged in A, technical analysis, B, quantitative analysis, or C, fundamental analysis. The correct answer is A. Technical analysts try to predict changes in the prices of securities by analyzing past prices, trading volumes, and supply and demand factors. quantitative analyst looks for statistical relationships between past prices and other company or economic data. And a fundamental analysis examines companies in order to estimate the intrinsic value of their securities and thereby identify under or overpriced securities. Okay, so you can see from this question, it can be easily changed into another question. You just have to understand technical analysis, predict changes in prices by using past prices. Quant is looking at statistical between past and other company and economic data. And then fundamental, examining the company's estimating intrinsic value. Those are the key words. Okay, I'm just going to finish this video. This is the last slide with my own nice to know, not need to know on passive or active. So anyhow, a gentleman named Charles Ellis, in his article, 3 Ways to Succeed as an Investor, outlines 3 approaches of investing. Okay, so this was from an article 2001, Charles Ellis, 3 Ways to Succeed as an Investor, 3 approaches. Because there's different philosophies, active or passive, and you have to choose your philosophy. And there's also different approaches. There's different disciplines. So anyhow, his 3 approaches. Number 1, the intellectually difficult approach. Number 2, the physically difficult approach. And number 3, the psychologically difficult approach. Intellectually difficult investing is pursued by those who have a deep and profound understanding of the true nature of investing, see the future more clearly, and take long-term positions that turn out to be remarkably successful. So you could see that is being really smart and being right, and that's difficult. Okay, it's intellectually difficult. Number 2, the physically difficult is most of the crowd, this is the investment industry, is deeply involved in the physically difficult way of beating the market in every way they can. They put enormous energy into trying to beat the market by outworking the competition. What they don't seem to recognize is that so is almost everyone else. So markets are efficient when they're efficient. It's hard to beat, it's hard to beat the other guy, the other person. And the psychologically difficult approach, being incapable of doing the intellectually difficult. I can't do that. I'm not that smart. And I'm reluctant about the physically difficult. I don't have the horsepower to do that. I don't have the time, the technology. I don't have the data. I have set about the emotionally difficult approach to investing. This is the passive approach. This straightforward, untiring approach is simply to work out the long-term investment policy that's truly right for you and your particular circumstances and is realistic given the history of the capital markets. Commit to it, and here's the emotionally difficult part: hold on. Okay, so that's buy and hold. And I must say that's a nice slide to end on, and that's the last slide for this topic and this chapter.